There are multiple reports today that Canada is considering retaliatory tariffs on a wide range of American-made goods, including orange juice and some steel products. The measures would be part of a response should U.S. President-elect Donald Trump proceed with a threat to impose a 25% tax on all products from Canada. The list of retaliatory targets is still being developed and is not finalized. Lundin Gold is one of the top stocks on the TSX this morning. The Vancouver-based miner reported preliminary gold production for the fourth quarter that beat analyst estimates. Stock up nearly 5%, as you see there. Lundin says it had a record production for the full year following the expansion of its mine in Ecuador. Meanwhile, the chief executive officer of nuclear technology company Westinghouse is stepping down. Patrick Fragman intends to leave his position to spend more time with his family in Europe. A recruitment process is underway. Westinghouse is jointly owned by Cameco and Brookfield Asset Management. Now, a look at the TSX. Going it alone today, it is pretty well dead flat on light volume, with U.S. markets closed today in honor of former President Jimmy Carter. It is a national day of mourning, which is a tradition. Our next guest says the energy sector has been going sideways the last 24 months, really. And while not all stocks are winners, he does have some names he says are set up pretty well for this year. Joining us now is David Szybunka, portfolio manager and managing director at Canoe Energy. Good to see you, David. Thanks for being with us.
Hey, thanks, Paul.
All right, it's Mark, actually, Mark Bunting. That's okay.
Sorry, Mark.
That's okay. I'm sure you're used to talking to Paul. That's fine. So I understand Canoe Energy funds were up about 25% last year. So how did you accomplish that in a year when oil was in such a tight trading range?
Yeah, we're pretty proud of what we accomplished last year. And like you kind of pointed out, energy is a lot more than just oil. And so we made a really good call mid last year. As you recall, there was a lot of geopolitical risk going on. A lot of people were looking up on oil. We went underweight. We weren't seeing the right things. So we went underweight oil as a subsector. And we also went overweight as natural gas as a subsector, as it looked pretty dire last summer with pricing. And so the combination of those two overweight, underweight calls alongside, we got a nice win when Tourmaline bought Crew, Altius Renewables went private, Paramount made a sale there to Ovintiv at the end of the year. So a combination of all those things caused us to outperform.
All right, so you see a massive bifurcation between the large energy players and the juniors. In fact, it's the largest spread really since 2001, according to Canoe. So why is that, and where are the opportunities there for investors, do you think?
Yeah, like to talk to that a little bit, I think it's important to really understand like more of a, how do you see the playbook for 2025? And what I would tell you is, as people recall, like our funds were up over 100% in 2021, over 50% in 2022. People entered 2023 really bullish energy. People entered 2024 really bullish energy. People are entering 2025 not bullish energy. We've been going sideways as a sector for 24 months. Our funds are up because we've been in these other areas of energy, moving chips around, outperforming. But the sector as a whole has been going sideways. And when you've been going sideways and other sectors in the market have been working and better, quite frankly, on a relative basis than energy, people have lost confidence. And so when I look at 2025, the bar has simply got set lower and lower and lower and lower. We look at positioning reports every week from B of A, institutions, hedge funds, retail. They are the most underweight energy they've been at since the COVID lows. So the bar is getting pressed lower and lower, and you make money in any asset class with positive surprises. I think we're setting up for positive surprises considering how low the bar is today entering 2025. As you start translating that to the equities, yes, there's a big bifurcation of large, intermediate, junior. I think this could set up for more M&A within the sector. Again, it could be one of those positive surprises, but at the end of the day, we like the setup for this sector today, given all those things I just kind of mentioned.
All right, David, you've got some names for us here, starting with Range Resources, the natural gas player out of the United States. This stock is up 35% since September alone. So what are some of the factors that you like about Range?
Yeah, one thing that's notable within our funds is I'd say we have a bit of a U.S. tilt today. When we look at energy, U.S. energy was flat last year. Our funds were up 25%, but U.S. energy was flat. U.S. energy has massively underperformed Canada the last few years here. And so we do have a bit of a tilt there today on a relative basis, and Range falls into that camp. Yes, it had a good rip the last 3-4 months, but it was down leading into that. So it was up small last year. And what I would say is we still like natural gas as a subsector. Yes, it's up off the lows. Yes, people are buying in more today. We've been pounding that message home for 12 plus months. There's more consensus there today than there was. But when it's all said and done, long life resource in natural gas with super low cost inventory, these assets still aren't priced to where we think they're going to be when the cycle's ultimately moving along. And so we still like the setup for Range.
Couple of names in Canada. We'll start here with Headwater Exploration. You say this is a stock that's been really going sideways for about 3 years, but that the cash flow is improving. What are some of the reasons here you like Headwater?
Yeah, I mean, you kind of just outlaid that when you look back 3 years ago, the enterprise value, market cap plus debt is the same as it is today. Well, 3 years ago, the company had 7,000 barrels a day. Today, it has over 22,000 barrels a day. When we look at last year, they went 9 for 10 on their exploration drilling. They announced another land deal this week. The waterflood's working with the company. The waterflood, this company's going to have over 50% of their production supported by waterflood by the end of the year. When you have that happen, the decline rate's going to go down. When the decline rate goes down, the sustaining cap goes down. Sustaining cap goes down, free cash goes up. Free cash goes up, you're going to get more dividends as a shareholder. And so when we look at a Headwater over the next 4 or 5 years, this company is going to free cash over 77% of their enterprise value with free cash flow. This is the highest percentage amongst any intermediate company that we look at in the entire universe. And so one of the best teams, best assets with the highest percentage, this should be one of the lowest percentages. And we don't think that that is going to hold over time.
Okay, that's high praise for Headwater. And lastly, an oilfield services company, Trican Well Services. You think this is another one that's mispriced, correct? What do you like here?
Yeah, again, we're talking about a gas company, an oil company, a service company. I think the setup for the sector looks pretty good. And when I look at a Trican, this company's bought back over 50% of their shares in the last 5-6 years, upgraded their entire fleet, and they're still sitting on cash. That tells you you should not be able to do that. That tells you the business has not been priced properly relative to its profitability. And so when we look forward, LNG Canada is kind of upon us. And we see a pretty good setup for the sector as a whole. Remember where that CAD dollar is. The pricing in Western Canada is really good. And I would say at this time last year, when we were at the Goldman Sachs conference, and individuals were betting that services were going to be the best performing sector in the market for 2024, it was actually the worst. And so today, 0 people at the Goldman conference coming out this last week here think that services is the place to be. I think that there's something to do there because of how much this sector's underperformed.